Good morning, everybody. Thanks for getting on this webinar this morning on a Friday morning. So my name is Danny Fitzgerald. I'm the Acting Regional Director for the San Diego and Imperial Small Business Development Center Network. We are, of course, a network of throughout both San Diego and Imperial counties of service centers, of service locations. We're here to be able to help small businesses in all aspects. And we provide free services based on our funding from the U.S. Small Business Administration, as well as from the Governor's Office of Business and Economic Development from the state of California. We have a staff of well over 100 advisors. Most are part-time. We actually have one, he'll be on the panel with us, one of our lead finance advisors, Spencer. And we really are here to be able to serve the small businesses, help folks access capital, which is one of our primary missions. While we've been doing a ton of work, of course, the last number of months, helping folks with PPP, EIDL, local grants, local loans, and all the above, we wanted to continue our conversations, as we always have, about capital to help you grow your business. And that's what we're here today. We have a fantastic panel of lenders that kind of help you fit in when you don't fit in the usual box of going to a bank. These are folks that can really help you out when you have the different situations and kind of look at things from a different perspective, because we recognize one size does not fit all, and that's what all of these lenders are here to do. And they're really here to help, to help you work with your business, to help your business succeed, and are all committed. We also want to thank for our Connecting with Capital. We have some sponsors that continue to support this programming. That includes Home Street Bank, Main Street Launch, CDC Small Business Finance, Primary Funding, and Marble Bridge Funding Group. We've got a couple of those folks on today as well. So we really appreciate that. So for questions, please go ahead and put them in the chat box. That just kind of keeps things a little bit cleaner and easier. And so we'll be able to, as we see those come along, we'll kind of throw those in as I'm moderating the panel. We'll also have folks put in the chat box there, the panelists will put in their contact information. So without further ado, I want to kind of go through and introduce yourselves from the lender perspective, and then we'll get to Spencer after that. So if each of you could just kind of introduce yourselves, the organization you work with, etc., and we'll kind of start with there. We'll start with Justin with WeFunder.
Hi everyone, I'm Justin. I work at WeFunder. We're a tech startup that's based in the Bay Area. I'm based down here in San Diego. We help companies raise capital by the company, and the founder is able to offer equity in the business and offer it out to people in their network, investors, customers, friends, and family. So it's an open platform. On average, you're seeing about 2/3 of the capital raised coming from the founder and their efforts to bring in investment capital in exchange for equity. And in addition, you're getting another 1/3 from WeFunder and our base of investors. So we have really benefited from what's happening with COVID. We're going through intense growth right now, and always looking for really high quality companies that are looking to raise capital.
Awesome. Why don't we move to Adela and/or Byron from Opportunity Fund? One of you two can introduce Opportunity Fund. First person off mute gets to speak.
Good morning. My name is Adela Escobar. I'm a Community Partnership Officer for Opportunity Fund. We are a nonprofit small business lender, as CDFI, micro lender. Our mission is to offer financial services to borrowers that do not qualify for traditional lending. We have been around for over 25 years, and we're offering working capital right now up to $50,000.
Fantastic. Why don't we move over to Fernando from Primary Funding?
Morning. Yeah, thank you. Thank you for having me. So Primary Funding, we are a community-based lender based right here out of San Diego. We've been around for 25 years now. Our focus is really with B2B industries. We offer receivables financing. We also dabble in some PO financing. So we're looking for companies in B2B industries with AR, and we help you leverage those receivables to make payroll, pay your vendors, whatever you need that capital for, really help you speed up your cash flow.
Awesome. Then we'll go over to Pete from LendSpark.
Hey, good morning, everybody. Thanks for having me. With LendSpark, we actually offer business loans, working capital solutions, and equipment financing. Small and medium-sized businesses, really all industries. We work with construction, logistics, and the medical field. Loans up to 2 million, but our sweet spot's really about 50 to 250. And yeah, we really our goal is to help get our clients into a bankable position. We're probably the next best thing and the best step to get you to obviously where everyone wants to be is having a good relationship with their bank.
Awesome. We'll round it out with Andrew from Marble Bridge.
Good morning, everyone. This is Andrew Crone. I'm Senior VP, Marble Bridge Funding Group. We are a commercial finance company. We're located in Northern California, but we do cover all over the entire state. We've been around 23 years, and I've been here about 20, going on 21 now. As a commercial finance company, we lend to businesses that are B2B, business to business. We're doing business with government entities. We fund via receivable finance, and we also offer, in certain cases, purchase order and contract finance. We work with startups and work with companies that are up to 50 million a year in revenue. Most of the businesses we see are about 250,000 a year revenue to 10 million in revenue.
All right. Looks like we lost Spencer here, so we'll come back to kind of some of the stuff that we do. So, but in short, kind of one of the things that I was going to have Spencer introduce is he's one of our lead finance advisors. We have a big team of folks that are professionals in helping folks access capital, access loans, and really be able to walk people through the process. And that's why we partner with each of these individuals. And so Spencer works with, he's a former bank underwriter. We have a lot of former loan officers that all work with us. So we're kind of moving on into a little bit more from the lending perspective is what type of loans does your organization offer? And so if you could kind of be specific, and also what are some of the fees and how's the program implemented? Why don't we start with you, Adela, from Opportunity Fund?
Well, we charge a loan fee of 5.99 of the loan amount, and it's you don't have to pay the fee up front. It's put on top of the loan. So that's the loan fee that we charge.
But what types of loans or funding do you offer? I mean, is it?
We offer a working capital, business expansion, trucking, food trucks, like transportation, business acquisition, business expansion.
Okay. Fantastic. And then why don't we move over to you, Andrew, from Marble Bridge for the same question.
Okay, so Marble Bridge Funding Group, as a commercial finance company, we offer receivable finance, and we also offer, as I mentioned earlier, purchase order and contract finance. We usually have a small application fee to get started with us. That usually doesn't happen until I've spent a lot of time with the client understanding the business and making sure it's a fit for us and also making sure it's a fit for them. And then once you're on board with us, if you're not familiar with receivable finance, it's a fee on the invoices you decide the fund to advance on. Typical advance rates industry-wide are averaging about 80% on an invoice, and it's invoice by invoice. So if you don't fund an invoice, there's no fee. If you do fund an invoice, there is a fee. We can work with startups. So we have no minimum funding requirements. Our clients work with us as needed to help and augment their cash flow. The only other fees that come in is the fee on the individual invoice that we fund. And then typically there's a wire fee as well when we wire you the funds. And that's about it.
Fantastic. Why don't we move over to you, Pete?
Perfect. Yeah, so the two main types of loans that we really have are when you're buying a piece of equipment for your business. So let's just say the construction company is buying a new dump truck, or you got your dentist getting a new dental chair, that kind of thing. And then the other kind of financing we offer is working capital solutions. So, hey, I need 100 grand for payroll or whatnot. Really any type of business inventory. As far as fees, we don't charge any fees to, upfront at all. We work basically for free for you to get your loan put together. Obviously, there's interest on our loans, and that obviously varies, credit factors, time in business, what types of loan, are you going secured or unsecured. But as far as, needing any money out of pocket to pick up the phone, to work with us, to even get approved, go all the way up to funding, you don't need anything.
Awesome. Why don't we roll over to you, Fernando?
Yeah, so very similar to Andrew. So we are, provide invoice financing on that end. It's going to be fee based, anywhere between 2 to 3% of the invoice that is submitted for financing. Same on the purchase order side. Where we vary a little bit is we do have the ability also to do lines of credit, bridge loans, term loans. So on that end, we typically have a monthly interest rate that we're going to charge of anywhere between 1.5 to 2% of the balance of the line or the term loan. So that gives us a little bit of flexibility there. If we're we need some capital for inventory and then also need to provide some invoice financing or something like that, we can usually provide a little bit more of a customized approach on that.
Awesome. And how about you, Justin?
Yeah, so most of our deals are based around equity. So companies are offering equity in their company in exchange for investments. We take 7.5% cash off of whatever is raised on the platform. We do also offer revenue share agreements where you can offer a multiple based on revenues. That's something that more Main Street businesses tend to elect that option. But equity is the primary source. We have convertible notes, safes, and price rounds that founders can work with us in creating.
See, I was guilty of the mute button. So one of the main things certainly that's important for kind of to help the small business owners that we have here is kind of understanding what they need to do to kind of prepare themselves to work with your company, to be able to access company through your organization, and in terms of everything from minimum credit score, if there's money in the bank, cash flow, personal guarantees, collateral, all that type of stuff. So why don't we start with you, Pete?
Perfect. So a lot of our loans for small businesses do tend to have personal guarantees. If you're only about 5 years, 6 years in business, probably gonna have a personal guarantee. When you reach that 10-year mark is when you usually, I don't want to say all the time, when you usually have businesses establish enough credit and they can stand on their own 2 feet without the need for personal guarantee. As far as what we look at for approving loans, it's depending on what we're looking for. We have working capital solutions based on cash flow. So credit's not so much a factor. We're really dialed in on the how much the company is bringing in, top line, and what we can do with that. We also offer secured solutions, so we could pull some money, for instance, out of a dump truck or a piece of construction equipment and get you maybe $50K on a more long-term structured note that's secured. We can also secure commercial real estate. We have a division that does that as well. On the equipment side, it's really more so credit-based. Cash flow isn't as big as a factor. It's more so previous credit history of the company and the borrowers that own the business.
Fantastic.
Did I leave anything out there?
I think you got it. You were thorough. So why don't we, Justin, why don't you kind of, because I know yours is a bit different, so why don't we talk a little bit about yours?
Yeah, so we work with companies that are pre-launch all the way through maturity. I think our sweet spot are companies that are looking for seed financing or a bridge to Series A. Our average raise is $350K, so that kind of frames it naturally. Our minimum is $50,000. Generally, I don't think WeFunder is a great fit. unless you can kind of generate investments from within your own network. I generally recommend if a founder can raise in the benchmark of 50 to 100,000 from friends, family, customers, investors, the likelihood that they'll be successful on WeFunder is very high. In terms of the kind of legal requirements, it's very different than a traditional lender. We don't have a lot of those kind of clear-cut kind of requirements within our process. So we kind of look at it on a one-to-one basis, and you know, we have an internal team that discusses the deal. But you know, from my perspective, it's really about if you feel like you have a strong network and a strong community, investors that want to be participate in what you're doing, you know, it's at least worth exploring.
Awesome. What about you, Andrew? Same
Hey,
question.
so to be a get on board with Marble Bridge Funding Group, the package is fairly standard. We're going to ask for financials, tax returns, things of that nature. We're doing that partly so we can understand the business and make sure it's right fit for you, and we get to know each other through that way. As far as credit scores go, as an example, we've had people with 580 credit scores and 800. So credit score isn't necessarily a determining factor. What we're looking at is to make sure it's the right fit, that your business is growing, and that it's going to work out well for you if you come on board with us, so you can grow your business a lot faster. We do require personal guarantees. Occasionally, we'll see venture capitalist funded deals where the owners only 5%. So in those cases, we probably wouldn't ask for it, but mostly closely held companies, we will get the personal guarantee side. Collateral, fairly standard in finance industry. You file a blanket UCC1 or a lien against all the assets, just like a bank would and other types of lenders. As far as projections go in cash flow, companies come to us, a lot of times they show losses. But they can show that they turn things around, and that works for us. So we do work a lot on projections as well. And those are the things we do to bring people in. Basically, the bar is a lot lower than any bank out in the marketplace. We listen to the story, we understand it. We find that if it's a fit for risk and it makes sense for us and it makes sense for you, we get together with our clients. And it's usually a very good relationship once we do.
Fantastic. Why don't we come back to you, Adela, with the same one, because you kind of got more traditional style loans.
Well, we are not a FICO-based lender, and our interest rate is not based on the FICO score. It's based on the loan amounts. The higher the loan amount is, the lower the interest rate will be. We do not have a minimum FICO score, but we require at least 580. Our loans are personal guaranteed, so we report both to your personal and your business credit score. And if a client doesn't have a FICO, this is a good way to start a FICO score.
Perfect. No, that's an important one. So then, Fernando, same question to you.
Yeah, so same with on the FICO side, we really are not basing our decision on FICO. I mean, it's great if you have a strong credit score, it will help in the overall decision making, but ultimately for us, it's based on where the company is at now. Financials are typically pretty minimal, but it depends on the product, right? So if we're doing factoring, it's really going to be based on that specific contract, on those invoices and the strength of the company that you're doing business with. So if it's a Walmart or a Home Depot or the federal government, there's going to be a very good chance that we're going to be able to finance those invoices. Whereas if you're doing business with, the mom and pop coffee shop down the street, that's going to be a very difficult deal to do. In regards to cash flow and projections, I mean, we really, again, it's more if we're doing a line of credit and, we're looking at that as more as like a bank would, then we're definitely going to look more at the financials, the quality of the financials. Are they CPA prepared as opposed to, internally through like QuickBooks or something like that. And then really we're looking at the composition of your accounts receivables. So, are you highly concentrated? Do you have one big customer that all your business comes from, or is that spread out between multiple customers? One or the other isn't gonna hurt you necessarily, but depending on if it's concentrated in one, how strong is that one client, right? And if it's spread out, then that helps to diversify and lessen the risk. So it makes it a little bit easier to, to potentially get something in place.
Fantastic. Well, we got Spencer on the phone. He had a bit of a computer glitch this morning, so we'll come to him with a kind of a good question, because I think there was some good terminology that came out. But that way, so you can kind of see where we roll in. But ask Spencer to kind of explain a couple of things about some of the stuff. So in particular, what, Spencer, if you can help us understand what kind of a debt service coverage ratio is, what cash flow means, and kind of what's important in a loan approval, how it's calculated, et cetera. I know you know this question well and can kind of help folks understand it. And you got yourself on mute. Let's see, let me help him get off mute. Can you go ahead, Spencer?
Okay. How
There we
about
go.
now? All right, loud and clear. Thanks, guys. Yeah, sorry about the technical difficulties this morning. And I kind of caught the end of some of the lenders. And as I answer this question, I kind of want to point out and defer to the lenders and articulate how these concepts that I'm going to explain are very general and consistent across almost all lending products and all lenders, but every lender has a slightly different way of interpreting these concepts in order to make loan decisions, and it kind of creates their business model. And it's not a uniform kind of black and white kind of thing that we're talking about. But to jump into the questions, debt service coverage ratio, it's similar to a debt to income ratio, say on a consumer loan. And the way you calculate it is you take the net profit on the business, and that could be whether historical in the last year or projection based on financials. And you divide that, and that's over a 12-month period. You divide that over what your monthly loan payments are going to be times 12. If that ratio is greater than 1, that means that you have some extra money after you pay yourself, after you pay all your expenses, to now pay the bank. So the banks want, in a general, very traditional underwriting sense, to show positive cash flow sufficient to cover that debt. Now that cash flow can come from a variety of different sources, whether it's from net profit. There's also another way to calculate it based on your receivables and your payables and your cash deposits. But the concept is that your business has to be making positive cash flow, and this is after your expenses. So your revenues come in, you take out all your expenses, and over a 12-month period, you want to be generating positive cash flow, and that's what banks underwrite to. So what was the other one? Where to go? Personal guarantee. That is similar. That is think of it in like a co-borrower almost situation, where the bank is going to give you a loan to a tax ID that is your business tax ID, but they're also going to have you, in most cases, not every loan will require a personal guarantee, but by and large, almost all commercial loans require a personal guarantee. They'll have you sign a second document using your own social security number that says you will also be responsible to pay the loan payments. So if your business goes out of business, all the assets are liquidated or don't exist anymore, the bank has the right to then ask you on a personal basis out of another source of income unrelated to the business to make those loan payments or make the bank whole. What was the other one?
What's a term sheet?
Term sheet. Okay. Term sheet is really more process related. And again, all these things are kind of general concepts, and each lender does it different. But oftentimes, whether it's verbal or in writing, you'll submit an initial loan application to a bank. And I think we'll probably talk about this later, which can be comprehensive, but that's the things like how they calculate the cash flow and see what your personal estate is to evaluate the strength of your personal guarantee. But a term sheet means typically that on the front end, a loan officer like Andrew or Fernando or Byron can evaluate that application and almost give you a pre-approval. And then from there, it goes into an underwriting process where the final actual credit decision is made from a back office typically. Some very few loan officers have lending authority, but it's typically a good separation of duties to have somebody bring in the deal, kind of frame it, articulate it. And that's what the SBDC can do, is we help you along with the banker kind of put that deal together. And then it goes to a back office where they underwrite it. And that's called a term sheet or letter of intent, LOI.
Fantastic. Thanks, Spencer. And thanks for navigating computer glitches and getting on with your phone. So appreciate that. So coming back to the lenders, want to kind of ask then, similar to some of what we just asked about with the small businesses, but what really kind of makes a complete application or, kind of has them ready to roll with it. I think, some of you touched on that with the previous question, but kind of nail it down for the small businesses and then what they need to do to really be prepared. Why don't we go ahead and we ended with you, Fernando. We'll start with you on this one.
Yeah, so our application's pretty simple. It's a 2-page app. The front page is really where most of the information is, but really, as far as financials go, we're going to need an AR, AP aging, that's accounts receivable, accounts payable. We're going to want to see some, most recent financials, some bank statements, and that's pretty much, the gist of it. I mean, we typically, like to see that you're working with somebody, either internally or externally that can provide those documents for you if you're not, especially if you're not really well versed on working with QuickBooks and things like that. But it's pretty simple. It's really only about 5 or 6 documents, and we can get going. And our decision process, we like to have, everything kind of wrapped up within 2 weeks. In most cases, we can get people funded within a couple of weeks. It just depends on how complex the deal is and what we're looking at.
Fantastic. And Adela, same thing for you. What kind of is, what is a complete package for you when someone's ready?
Basically the same as Fernando, a 2-page application, the picture ID, proof of business, usually 3 months of bank statements and tax returns. And if they have filed an extension with the IRS, we will need the extension. Right now for the 2019, we will request the 2018 tax returns and a profit and loss statement. And our turnaround time is usually between 5 to 7 business days once we have all the required documents.
Fantastic. What about you, Pete?
Yeah, LendSpark's actually really simple to work with. Loans up to $150K. For equipment, it's just an application, 1 page. That's all we need. For the working capital cash flow based solution, we do up to $150K, application only as well, and just 3 months of business bank statements. On the larger loan amounts, $150K and up, the only items we'll typically need are tax returns, accounts receivable, and the year-to-date profit and loss. Turnaround time for approvals is usually 24, 48 hours. Sometimes we're lucky enough to get them same day. And then depending on the type of loan you have, we can fund some as quick as 2 days. Some take about a week or so.
Awesome. Then Justin, again, you're the unique situation, but I know there's some process before you kind of get rolling with WeFunder.
Yeah, so we need 2018, 2019 reviewed financial statements and an investment contract in order to launch. Generally, it takes about 3 weeks to get a campaign live, and then the campaign will run for 3 to 6 months. And founders are able to pull money periodically from what they've raised on the platform. So you're looking at probably a 6-month process overall, 3 weeks to get set up.
Fantastic. And what about you, Andrew, with Marble Bridge?
So we have a 2-page application. Page 2 is just your signature. So it takes probably about the average person 5-10 minutes to fill out. We do gather a package, but in the conversations to get into the relationship, I gather a lot of that with the individual business owner that I'm dealing with, so I can understand it. I do the underwriting as well, so you're not dealing just with a salesperson, you're dealing with the person who is going to introduce you to the company. So I, with 20 years experience, can pretty much figure it out in a phone call whether we can even do this deal or not do the deal with the client. So it saves them a lot of time. If we are into it, then we will gather the package. Everybody's ready to go forward. And, you know, the speed of that really depends on the business owner. Some are very organized, some take maybe a week or so. But as soon as they get the package in, underwriting's usually done within 72 hours. And it's a go. We can go ahead and sign, and then they could actually do their first funding right when they've signed. So funding would usually take probably 24 to 48 hours at that particular point.
Fantastic. And then Spencer, you know, hearing all the, you know, the different processes as well as the processes, you know, from even other lenders, you know, I know your role and your fellow SBDC advisors. So really, what do you do to kind of help a small business owner understand what they need to do in choosing a lender and preparing their loan application? Let me help you get off mute. There you go. You're good to go.
That's a great question, Danny. And this is very common for many of our clients, even which might be unsophisticated or unexperienced in making applications. Maybe this is their first time, or maybe it's a business owner that is a great entrepreneur, but maybe doesn't have a good kind of organization of all these data and financials. And oftentimes, whether the first or the second, or just any typical application, if you've done this 5 or 10 times, a lot of clients are nervous about, no offense, Andrew, some of these conversations, and they don't know what the answers should be. And it's not that there's right answers, but, you know, they want to be prepared. And this is what we can help our clients do going into those conversations. And then also, more importantly, backing it up with the financials to show that the numbers back up the story. And we'll help you prepare those loan packages. We can even submit it to, I know all these guys on the panel, on your behalf to the lender. I mean, we're not a lender. You're just filling out an application with the lender, but we kind of try and get it teed up as much as possible, which I think the lenders may speak to this later. It's beneficial to them as well, so they don't have to go through all the due diligence and chasing of documents that, you know, you might be as a borrower a little bit nervous about providing, and do they look right? I mean, it's not like you're trying to pull something over on them. It's just like, what are these supposed to look like? Am I doing it right? So we can help you kind of articulate that and frame your loan request to give you the best chance of getting approved.
Fantastic. Yeah. And again, just to kind of reiterate what I said earlier, all of our services that we have from the Small Business Development Center, they're at no cost to you. All of our advising that Spencer and his fellow advisors do is all confidential. And we're not a lender, so we're not, you know, and we're not a broker. We don't make money on any of this. So that's really what we're here to be able to do and kind of help folks out. So coming back to our lenders, a good question is kind of, I guess this is kind of a good and a bad. So kind of an example of how you helped a small business obtain a loan, and as well as kind of a loan that you worked on that was denied, kind of showing some pitfalls on that. So kind of some winning, you know, things that help folks be able to get approved, and things that are kind of pitfalls with working with your organization. And why don't we start with Justin, because again, his is kind of a unique situation.
Yeah, for sure. So a lot of times people look at WeFunder, there's a bunch of companies and they're raising tons of money, and there's a lot of activity going on. If you go to the WeFunder website, you can see live companies that are fundraising right now and get a good idea of kind of what the deal is. I talk to some companies that'll come to me and they expect that, oh, I've got a great business and I'm just going to post it on WeFunder and watch the investments roll in. That's not really how it works. It really is a platform by which you are sourcing investments from your own network and your own community. And if you don't have that, you know, that appeal and that, you know, that pull from friends, family, customers, and investors within your own network, WeFunder is not really a great option. But if you do, WeFunder can help accelerate those efforts, and the money that you raise will be compounded by the exposure and the investors that we bring into WeFunder. So I think that doing an honest assessment of kind of like, who are you? Are there real investors that would want to invest in you? And could you raise capital? If the answer to that is yes, then, WeFunder would be an attractive option, because then you can kind of raise, your upside is higher as a result of the exposure and the investments coming in from our network.
Awesome. And then Andrew, coming to you, kind of the same sort of thing. What's an example of how you helped a small business obtain a loan? What were some of the things that made them successful? And then the flip side, what are some of the pitfalls, that result in the denials?
All right, so there's plenty of success stories. That's what I strive to achieve with every client. One that comes to mind is sort of a cute story. We had a toy importer, very small, doing about 200,000 a year, designed toys for other companies, had his own little toys that he would import. And then he hit a home run. He created something I think you guys can relate to, called a Tooth Fairy box. And so people normally, when their child would have their tooth fall out, they'd put it in a baggie and they'd stick it under the pillow or something like that. He actually created a box for a boy and a girl with a pink pillow and a blue pillow and a little mirror. And so they put their tooth in the box next to the bed. The price point was about $15. So that's right in there in the gift industry to sell out really well. And his landed cost was like $4. So he put that into the marketplace and people couldn't keep it in stock fast enough. He didn't have any net worth as far as a home with equity. He didn't have a strong credit score, so the banks wouldn't look at him. He got referred into Marble Bridge, and we took this business from 200,000 a year to 2 million a year in 1 year. He went from like 200 accounts to almost 2,000 accounts nationally. And in order to make that happen, we had to go beyond receivable finance. We had to go into purchase order finance and give him money in advance so he can send the money overseas to get the product made and get it in faster. And he just turned it faster and faster and faster. So that was a very good success story. He was done with us with 1 year. Now the banks were interested in him, and he graduated, as I call it, from Marble Bridge back to the bank. On the failure side of businesses, I do a lot of work up front with my clients, probably more than most. Spend many hours. I make them an expert in our particular product. I really want them to understand exactly how it's going to work, that there are no questions whatsoever in their mind, and that's why they come on board with us. But that being said, every once in a while, in a blue moon, luckily it's rare, I'll have a client not answer one of my questions, which truthfully, which is like any tax liens, judgments, lawsuits, anything I need to know in your past background. And occasionally on a rare blue moon, somebody doesn't give me that information. So I, say, all right, it looks good. We're going to bring you in here. Send me your application fee. And I get the fee and I cash it. And then I do the due diligence and I discover all the stuff they didn't tell me. And then I have to have a separate conversation that, we can't help you and you weren't honest with us. And, as lenders, we're going to be your partner. We got to know what's going on, and you should have told us that up front. And maybe there was a different way to mitigate it. But at that point, that would be a deal that wouldn't happen at our end.
Honesty. Fantastic. All right. What about you, Pete?
Yeah, a couple good success stories we've had recently. One real quick, we actually were able to utilize clients, commercial real estate, and basically get them out of a couple different loan positions they were in that were more short term and a lot higher interest, and kind of hit the reset button on his business, help his cash flow out. Also recently, we helped out a local electric company, small, medium sized, acquire 6 different trucks, just work utility trucks. But it was pretty difficult because it was 4 different vendors across different states. We do fund nationally, so quite a challenge, lots of paperwork. We got it done in a timely manner. A deal that didn't go so well actually recently because of certain situations out of our control was a pretty established business looking to purchase a food truck. They had 2 restaurants already. They were looking to buy a food truck to expand into another location. And based any, 6-12 months ago, this deal gets approved almost application only, no problem. We had a very tough time getting it done, and ultimately we could only offer a 3-year loan option for them, which didn't fit their budget and cash flow restraints. So usually we get a 5-year, but because of the certain situations with credit tightening up, especially in the food and restaurant industry, we weren't able to meet in the middle on something. We did approve it, but ultimately they had to walk away, and they're going to wait, a couple more months until hopefully things get a little bit better. But that was a tough one.
Fantastic. All right. Thanks, Pete. What about you, Adela?
Well, we also have a lot of success stories with our clients, but I can think of one that we help a home-based business owner to get a loan to get some equipment for his landscaping business. So we refer him to, after we gave him the loan to purchase his equipment, we refer him to the SBDC, where he was able to get a lot of resources and advice to open his business bank account and to convert his business to a corporation. And when we get denials on our applications, I also like to give them resources so they can go to other places to get the help they need.
Awesome. Fantastic. What about you, Fernando?
Yeah, we had a great win recently. Company that manufactures beauty products, and right now they primarily sell on QVC and Amazon, and right now those companies that are selling to people that are stuck at home are really booming right now. So this individual had an opportunity where he had to buy out one of his partners. Unfortunately, that partner came along with a working capital line of credit that he very much needed. So he had a $500,000 balance on that line that he needed us to take out, along with helping him to finance the buyout of the partner, and then ultimately providing additional working capital for him to continue to operate and meet all these new orders that he was getting. Some of the challenges were, that one of his clients, his biggest client that he dealt with was QVC, which unfortunately QVC doesn't always have guaranteed sales. A lot of their sales are consignment. The good thing was that a lot of his sales, he had guaranteed amounts that were very high. So in the 80 and 90% of those POs were actually going to be guaranteed. So we were able to get creative. We were able to provide the pay off the line of credit, give him some capital about his partner, and then also provide a factoring line of credit along with some PO in there. It's a pretty complex deal, but we were able to get him everything he needed so that he was able to buy out his partner, move away from that existing line of credit and continue to operate and continue on his current growth trajectory. So that was a great win for us that we recently closed. A deal that we had to pass on, companies that have been hit hard right now are companies in aerospace and that deal with Boeing, for example, and things like that. So we had a company that also was needing to leave their existing lender. The issue here was that they were really upside down in regards to their AR and AP. I mean, they had about $2 million in accounts receivable, had about $10 million in accounts payable. So you can imagine, I mean, it was just a very desperate situation. And then on top of that, when we dug into it a little bit more, it turned out about 1.5 of those receivables were actually going to be charged off. So really they had like $500,000 in AR. These guys were in a really tight spot. Unfortunately, no matter how we looked at it, the guarantors, they weren't really, the owners weren't willing to guarantee either. And so that made it even more difficult for us to do anything. So we had to walk away from that one just because of the amount of risk involved. And we didn't see how they were going to be able to right the ship and really make it work.
Fantastic. Then we'll come to you, Spencer, because I know you see a whole bunch of things in terms of that. But what are like the couple of things to really trip up a borrower? You there, Spencer?
Yeah. Okay. I thought you just cut off there. Yeah. Well, I think one of the lenders, in my experience, hit it on the head. I had an example when I was a banker. This was 5 or 10 years ago. Somebody had gone through the whole application process. It was a major commercial real estate deal, and they'd paid thousands of dollars for an appraisal. and they had sent in the information, and one of the documents you send in for information ultimately to get funded is you ask for a copy of your corporation paperwork or operating agreement, which establishes who are the owners of the business. And you can also see that on tax returns, but it's part of the application process. Sometimes you submit, by the way, documents up front, and then you have to submit additional, just more administrative type documents on the back end in order to get funded. Anyway, so we had underwritten the loan, approved it, spent a lot of time on it. It was a complex deal. And in the end, we got a call from the partner who had explained that there was some legal stuff going on between him and the partner who was running the show and making the loan application, and it violated what the structure of the corporate entity looked like. And so, I mean, that was almost fraud at some level, and we had to unwind that, and it was a pain in the butt. So that's probably something like that, whether it's a tax lien or past due child support or something that is unsavory that comes up after the fact is really something that really trips you up. The other stuff is just, the fundamentals of business, not having cash flow, or maybe underreporting your income or overreporting your expenses for tax purposes. A lot of small businesses, when they're starting, they do that, and oftentimes those things are consistent with generally accepted GAAP principles. And there's a little bit of wiggle room of timing of when you recognize income or expenses. So it's not like they're doing anything wrong, but on paper, the fundamentals of business don't add up. So that's where our advice and education can teach you how to do those things properly and put you in a good position to get approved.
Awesome. So we're going to go into our last question, but if you have any particular questions, please put them in the chat. We'll have a minute or two to kind of answer a couple of those specific questions. But the question I'm going to have for the lenders is just kind of straightforward. We've talked about some of the trip falls, your success stories, but what are our kind of one or two tips you can really give a business owner to be successful? Either successful kind of in the operations, I know we've talked about that, but also, with your application. And why don't we go ahead and start with you, Pete?
Yeah, it's the first easiest tip I have for everybody. It doesn't take too much time. Is to go online and make sure all of your business addresses, phone numbers, everything is up to date. Believe it or not, it's one of the first things we do is we go and we Google the business and we make sure, is his address really where it says he is? And, is everything consistent with the app? And I'm going to say 50% of the time it's not the case. And we get back on the phone. Hey, is this the right number? Or is this the right address? And it just creates a little bit of a roadblock. So that's an easy one. And then the good tip I have is just making sure you tell your loan officer, whoever you're working with at the SBDC, the whole story. What I mean by that is tell them, you might be applying for a business loan, and you might not tell them, hey, I own a bunch of dump trucks free and clear in the business that they could utilize. Like, make sure you tell them, hey, I have this commercial real estate property, could be in Texas. You never know what we could do. You never know, we can get creative on a product. We definitely don't want to find out in the 11th hour that we had a better solution for your need.
Awesome. What about you, Adela?
What I would recommend is not to run your credit with every lender that is offering you a loan, because every time somebody runs your credit, your FICO score will go down. So just make sure that the one that you are applying with, it's the one that you want to go with. And another tip I will tell them is to sit with a consultant. I would recommend an SBDC consultant, and talk to the consultant about your plans. And they can walk you through the process. They can help you build a business plan and help you with all your licenses or permits if you don't have them.
Awesome. What about you, Fernando?
Yeah, definitely echo that sentiment with Adela. Just start with an SBDC consultant. I mean, they're going to be your best starting point as far as making sure you have all your ducks in a row to get a favorable outcome. I think just, be honest is one of the big things. I mean, it's going to come out, you know, like whatever we have processes in place to do our due diligence and make sure we understand all of the risks. So we're going to find out if there's anything you don't tell us about. It's just funny how a lot of borrowers I'll run into try to hide things, and then it comes out in the end, and it just looks bad. We're in a high risk industry, so we know there's going to be some ugly aspects to your loan application. But once we see we really can't trust you and you're hiding things from us, at that point your credibility, you know, is diminished, and now it's a judgment call. Like, can we actually even trust this person? You know, we were okay with all of the ugly stuff that we found, but now we think they're going to lie to us. And is that something that we can deal with? Do we want to be always double guessing? So that would be my biggest thing, is just be honest, be upfront about everything, be open about everything. And, you know, we'll work through it. It's a partnership, right? We got to work through it together.
Awesome. What about you, Justin?
Yeah, if you could just go to the WeFunder website, I would highly encourage you to just look at the different campaigns that are running right now to get a feel for what types of businesses are successful and what types of businesses are generating a lot of capital. We have really great information on our website. In the top right-hand corner, if you go to Raise Money, that is all the information that you'll need, as well as our FAQs. So if WeFunder might be of interest, that's my best suggestion on where to start.
And Andrew.
So I would say the most important thing as a small business owner is really make the best effort you can to understand your financials and produce decent financials. A good portion of the companies that I see, the financials are incorrect. They're not done in a presentation that makes any sense, that helps the owners. In those cases, we've done a lot of work over the years to hook people up with consultants. And to that end, the SBDC is usually one of my first go-throughs, because it doesn't cost anything to talk to the people there. And they have expertise in every different category you can imagine, whether you want to do government contracts, whether you need financial help, or whether you need, marketing or anything in that area. I mean, it's a very tremendous organization that a lot of business owners don't know about. Those of you who are watching today, you want to take full advantage. I mean, it's a free service. But on the side of when you're going with a lender and you're presenting your business, I mean, that's what we're going to be looking at, is talking about the numbers and gauging how well you know them. So if you have a mentor from the SBDC to help gauge and put together a program and make sure you know your stuff, when you come to the lender, it makes it very easy to get through the lending process.
Fantastic. Before we jump to Spencer, we got a couple simple, quick questions that are there. We had, in the geography is irrelevant. I know we're focusing on San Diego, but I think most of you do serve other parts of California. We have someone from Bakersfield, and I believe you all would serve elsewhere in California. I think the only one I don't know for sure is Fernando. You serve elsewhere in California, right?
Yeah, we're nationwide.
Okay. Yeah, so everybody would be able to help this person in there. And then Kevin had asked, do you have some additional information? I know some of you put your contact information in the chat box for kind of some of the follow-up, and Pete put a couple of websites in there too. And then we will be sending out a recording of this to everyone who registered. So we will have that information, and you can always reach out to us at the Small Business Development Center, and we're able to kind of help you out. So we'll wrap up here with Spencer. I know you live in giving tips and helping businesses, but what are kind of some of the things really that you see that are super important? Let me take you off mute.
Well, I was prompted to say go to the SBDC, but our lenders did such a great job of helping market us. Thank you, by the way. I think that's been covered. We do try to work as a partnership with our lenders and also our clients. We're kind of an advocate for both. Our whole goal is to help money come into the community, and every lender is a for-profit business. Every time they can do a loan, it helps them. And these are good loans. And that's kind of the hard part, is sifting through the wheat from the shaft. And, some of the advice I would say to get around that is to, let's see, what's the best way to say this? I mean, it's difficult for small businesses, but I think if you can keep because you're putting all your money and time into the business, but if you can keep your personal estate in good standing, meaning you have a positive net worth, which means you have cash in the bank to offset your credit cards, or you have equity in a home to offset the debt on that home, or you have an IRA, or you have some sort of secondary source of income that can pay your household expenses while you try and get your business off the ground. And, that goes back to FICO score too, and the character issue that Fernando did such a great job of explaining. If you can demonstrate that on a personal level, you're probably most likely to be successful in your business too, and you'll manage that accordingly. And that will, help you get to where you want to be.
Fantastic. Well, I appreciate everybody. I think we had one quick specific question in there. I think some answered it because I know most of you don't lend to nonprofits. And I don't think there was about the WeFunder model, and it doesn't really work with the nonprofit, does it, Justin? It's based on an investment model.
Yeah, it would be a unique situation. It would have to be a nonprofit with a business model, and it's something that we could explore. We have supported nonprofits, but it's certainly untraditional and not typical.
Cool. And I saw Andrew said he does work with nonprofits, and I think Fernando, do you as well, or?
We can. We've done it in the past, so it's definitely there is an opportunity to do so.
Awesome. And again, at the SBDC, we can kind of help you also with that situation. We work with different lenders that do work with nonprofits, and we do have some advisors that have expertise in nonprofit assistance as well. So again, I want to appreciate everybody for getting on. It really was a pleasure, as always, to kind of be able to chat with some of our lenders and continue to learn, because I know our capital markets right now with COVID are ever changing and a bit fluid, as well as all of our financial situations. And so it's kind of a crazy situation. That's why we're going to continue to do this series every month. So the second Friday of the month is with bankers. The third Friday of the month is predominantly with nonprofit lenders, and the fourth Friday of the month is predominantly with our alternative lenders. And we want to thank again our sponsors of Connecting with Capital, which includes Home Street Bank, Main Street Launch, CDC Small Business Finance, Primary Funding, Marble Bridge Funding. I really want to thank Fernando, Andrew, Adela, Justin, Pete for joining in on the panel, Spencer for adapting your situation, and with everything. So really appreciate everybody for getting on this morning, and again, stay safe, stay well.
Thank you.
Thank you.
Take care, everyone.
Have a great week. Thank you. See you next time. Send everybody to the SBDC.